computer. And okay, I think we're all set there. All right. Any other questions about Bloomberg, about getting your account set up, or anything else related to the class? I don't see any hands or anything, but feel free to just unmute and jump in at any point if you like. All right, so let me go back to this. Think this is going to work now. So, all right. So we ended class last Tuesday talking about how to annualize a return. I'm going to try to finish up this chapter, at least get done midway through the class period today, and then we'll get into chapter 2. Hopefully get the bulk of that done. We'll finish up whatever we miss on Tuesday. By the way, don't forget, just as a reminder, homework is due, and that homework is just reading chapters 1 and 2 using the SmartBook 2.0 in Connect. I haven't looked to see how many of you have signed up, but make sure you sign up for that right now. The first due date is tomorrow at midnight. So go through, answer all the questions on the SmartBook. That'll give you credit for those 2 assignments. Then the next due date is also before our next meeting. That's on Monday night at midnight. And again, it's just reading, but you do need to answer the questions in the SmartBook 2.0. So go back and you'll be reading chapter 3. Make sure you do that before midnight on Monday. And then from here on out, every assignment is going to be due Monday night at midnight. So just put that on your calendars and make sure you leave enough time over the weekend to accomplish that. Don't start at 11 p.m. and expect to get done. For the most part, it's going to take you a few hours. All right, so let's see, back to annualizing returns. The next thing in this chapter is talking about a variety of different types of securities and the long run performance of those securities. You can see clearly, small stocks have huge gains. Remember, we're going from 1926 to actually 2018. They only see 2016 on the bottom here, but the data actually runs all the way to 2018. Next is large company stocks. Starting with $1 back in 1926, you'd end up with almost $6,500 in 2018. If they were small company stocks, you'd end up with nearly $30,000. By the way, also notice the scale here. The scale is a logarithmic scale. And so each increment is an order of magnitude bigger than the prior one. So it goes 1, 10, 100, 1,000, and so forth. That's why, we see 30,000 here and it doesn't look all that far away. By the way, it's really important that you look at these things when you're looking at any sort of data presentation because, I forget who the quote is attributed to. There are lies, damn lies, and statistics, right? And you can lie all day long with statistics. So be careful. Watch what you're looking at. Look at the scales. The other couple of items here, we've got long-term government bonds. You'd have $130 after starting with $1 93 years ago. Treasury bills, and then inflation. Couple of other things to note about this. This doesn't have to do with statistics as much as it has to do with actually implementing a strategy. Let's say I were to put $1 into small cap stocks. And when I say small cap, that is small companies. Cap is short for capitalization, right? So small cap companies. I put my dollar in 1926. And I'm supposed to end up with $30,000 in 2018. Suppose I don't, though. Why wouldn't I? Any ideas? Why might I not end up with $30,000?
Like a financial crisis or something occurs?
Yeah, right. And if I happen to be in just one, thank you, Spencer. Yeah, and there have been a number of them since then, right? 1926. So let's see, that's about 3 years before the Great Depression. So yeah, if I put it in the wrong company, it could be totally gone. So that's one thing that I have to be careful about. I need to diversify across many small companies. Even if I do that, though, how many small companies that existed in 1926 still exist today? And still are small companies. Some of them have grown, some of them have just disappeared, right? So, what else am I not calculating into this potentially?
Like
Small
Foster,
company stocks are more risky than large company stocks.
You're absolutely right about that. Yeah, and that's why I'm getting this, presumably why I'm getting this extra return, right? But what is it about? Let's think about just a very practical element of this.
like
What happens
Foster,
when you? Oh, go ahead, Brett.
I was just gonna say, like, we're not including the growth of these small companies, kind of like you alluded to, where we're assuming these small companies stay small companies for this extended period of time, which really isn't that likely.
Okay. So what happens if a small company becomes a big company, and I want to keep this portfolio as small company stocks? What do I have to do?
Buy more small company stocks, or I mean,
Yep.
you have to, now that it's a large company stock, you have to put it with the large company stocks.
Right. Or I even just sell it, right? I'd have to
Right.
sell it. What's that going to do? That's going to generate costs. So this graph doesn't factor in commissions. It doesn't factor in transaction costs, my time to actually follow this stuff. So when we do that, these numbers change dramatically. So this is a portfolio that is completely unattainable as it's drawn because it doesn't factor in those transaction costs. And you might say, well, I can trade stocks for a couple of bucks commission. Well, that's true today. That wasn't even true 10 years ago. And it definitely, if we go back 20 years, commissions were at least double digits, if not into triple digits, just to trade one stock. So it wouldn't have been unusual in this period of time, over the majority of this period of time, that a commission was $100. And it would take a long time to make that trade relative to today. So keep that in mind too. This is net. This is not net of commissions and transaction costs. So really, these are the best case scenario. In fact, if I were somehow in the business and I had very low transaction costs, I might get close to this, but nobody else could. If we look at it over a longer period of time, here a couple of 100 years, we see that stocks in general have done extraordinarily well. And again, note that this is a logarithmic scale. It goes up one order of magnitude for each increment. And then we've got bonds down here at 42,000, short-term fixed income securities at 5,500. And look at gold. Interesting thing about gold there. Actually, gold does seem to track the CPI fairly closely. So people will often use gold as a hedge against inflation. I'm not endorsing that. When you look at it more closely, that's a dubious relation there. But some people do that. Now let me go back here just for a minute to these small company stocks. Let's talk about trying to get an actual. Come on, there we go. Let's try to figure out what sort of annualized return we might have on these guys. And so what can we do here? We're going to take that 1 plus the let me scratch that. What I'm going to do is I'm going to take the ending value. And remember, if I'm trying to take a period that's longer than a year and get an annualized, I'm going to raise it to 1 over the number of years. So the power is going to be 1 over 93 years. Then I want to subtract off 1. All right, so let's see what that gives us. 11.7%. That's pretty close. Now remember, this is a geometric return that we're looking at. This is a compound return. We're going to find that the arithmetic return is a little bit higher on these things. But yeah, so we're getting somewhere close to 12% geometric average return on small company stocks. If we do large company stocks, we've got 64.62 divided by 1, or raised to the 1 over 93 power minus 1. And that gives us, still not bad. Even though, notice, I mean, we've got a huge dollar difference here, but the geometric average annualized return is not all that different. So that's informational too. That's informative to us too. So, you know, every little basis point that I can pick up, if I expand that over a long period of time, is going to mean a lot more money at the end of that period. So that's an important insight to have here. All right, so let's go on and look at this year by year. If we look at large company stocks, this is the annual return on large company stocks. So we're talking about S&P 500 blue chips type stocks, very large firms. Also, again, notice the scale here. So we've got negative 60% all the way up to positive 60%. And most of these, you know, fall somewhere under 40. We've got a few that pop up above that. And most of the negative returns, with a few exceptions, are, you know, less than 30-ish negative. Obviously, we have the crash right here. We've got the financial crisis right here. So these things do happen. They're not terribly infrequent, and they are fairly dramatic. But then you'll look at the years following that, and those are some of the larger returns right here. So that's also informative and helpful to understand. If we go to small company stocks, again, watch the scales. Can be deceiving. We're actually running from negative 100 to positive 200% return here. And again, most of them fall somewhere between the, you know, in terms of, we've only got one that is extraordinarily high right here, 150% return right after the great crash of 29. But generally speaking, they are a little bit riskier than our large companies. I mean, large companies were staying well below 40% return and usually not worse than negative 20, whereas here we have several that are negative, close to negative 50. These are up into the high 30s and 40s right here. This one looks to be like around 30-ish. So some significant downside risk on the small companies relative to the large companies. But you also have quite a bit of the upside as well. If we go to long-term U.S. bonds, again, scale. Here we're going negative 30 to positive 60. And you'll notice that the first, almost a little more than a half of the period, relatively modest returns on long-term bonds. Right here, 1980, DID MCA occurred. The Depository Institutions Deregulation Monetary Control Act occurred. That, in my opinion, and this is definitely opinion, I do like to try to separate out when we're talking fact versus my own opinion based on my analysis of the facts and the circumstances. In my opinion, that triggered some of this higher returns here. Now, it certainly did immediately after it occurred. I remember looking at mortgage rates in the 80s, and they were double digits. So whereas mortgage rates today are down in the, well below 5%, 3% something, they were up around 12, 15, even 18 plus percent for mortgages. So what the DID MCA did in particular is it deregulated interest rates. Up until that point in time, interest rates could never be paid more than a fixed amount. So I think that amount right around the time of the DID MCA was about 5% on a savings account. So if you were to shop around, you would never find a bank offering more than 5%. Now they might give you a toaster or a microwave or something else as a incentive to sign up with their bank, but they could not pay you more than 5%. The DID MCA did away with that cap and allowed banks to pay more and be more competitive. It took a while for the market to assimilate and work through that. There were a lot of bank failures, especially the S&L crisis occurred shortly thereafter. And again, my opinion was probably significantly affected by that and caused that. But that should have been worked through the marketplace roundabout by 1990, early 90s. So here we still have a lot of volatility even after a major change in the institutional structures. So lately, though, you'll notice right here, the recent period has been quite back to kind of what we've experienced in the first 50 or so years of this window. We go to T-bills, and we notice, again, watch the scale here. Here we've got a maximum of 16% return, so these are really quite stable. And again, you'll notice that peak around the 1980s, probably, but not a fact, probably related to the DID MCA. And then also notice here, we had periods of time where we had interest rates on T-bills close to or at zero. Other countries actually went negative. Economists just don't even know how to think about negative interest rates. Their heads blow up when they go into negative interest rate area. I mean, there's no theory behind that. So actually something I noticed here, anybody have any idea why there are no negatives here? Nothing drops below the zero line. What's up with that?
I believe at the end of at maturity date of Treasury bills, you get back your principal, so you can't lose.
Right. That's correct.
On the
So
negative.
up until this time, there has never been a default on a Treasury instrument. So you're correct about that. Actually, there have been two periods of time, once under Clinton, once under Bush W, where they floated the possibility of defaulting on a Treasury issue. And the basic response from the marketplace was, "Are you nuts?" So they backed away from that. But that wouldn't necessarily, that's just default risk. Because these aren't necessarily caused by default risk. There are a couple of things going on here. Let's assume, in fact, since these are U.S. bonds, long-term U.S. bonds, and I believe they are, not sure whether they did government and corporate or not. If they were corporate, they would have a default risk, right? If they were just government, they would have no default risk. But so Andrew, you're right about no default risk, but that's not why we don't have any bars dropping down below the zero line. Any other ideas? What's the term of a T-bill?
Isn't it a year?
Yeah, it's less than a year. It's a year or less. So as a result, if we have no default risk, and T-bills, by the way, are what are called discount instruments. So we don't get coupons, we don't get interest payments. We buy at a discount to the face value, and at the end of the T-bill, we get back the face value. So the difference between those two is the amount of interest. So as a matter of fact, and we never, because we're measuring over a 1 year span, and these things are less than 1 year, we never actually have a loss as long as interest rates are positive. Oh, pardon me. So this is not unusual. This doesn't mean that there is no risk related to treasuries or to T-bills. Just means that when we're measuring with a year as our window, it doesn't show any interest rate risk. Now, obviously, if we buy a treasury that is yielding 2% and rates go up to 3 or 4%, the value of that treasury has dropped if we sell it in the marketplace. But more about that when we get to talking about fixed income instruments. If we look at inflation, again, look at this scale here. It too is quite low volatility. Now, when we're trying to calculate returns and measure risk, we need some instruments to do that. And here we find that the best instrument to do that is, or one of the instruments to do that, is a historical average return. And this is an arithmetic return, average return. So we simply take let me change the color of this pen. We simply take the yearly returns, we add them up, and by the way, if you're not familiar with the capital sigma, we'll use it quite frequently, so get used to the mathematical use for that symbol. Is what it says is sum everything to the right of this symbol, and in particular sum everything to the right that has a subscript on it. You'll notice the subscript here is I, and so this return has a subscript as well. So we're taking the ith return. So if it's year 1, I equals 1, that's the first year. Then we increment it up once we've found that figure, and we add to it the second year return, and add to that the third year return. So basically what this summation means is if I'm summing something from I equals 1 to 3, and let's say that I've got xi, that's equivalent to, and let's see, let me have x1 equal to 3, x2 equal to 4, and x5 equal, or sorry, what am I, come on here. x3 equal to 5, what I would effectively be doing is saying 3 plus 4 plus 5 equals 12. So that notation is just shorthand for add all this stuff up from year 1 to year n. Now, what I'm going to do then to get my average is I'm going to divide by the number of years that I'm adding up. All right, simple arithmetic average. That gives us a measure of what I would call centrality. Where's the middle of our distribution? And when we do that for various types of securities, we find that large companies have an arithmetic average over a long period of time of around 12%, 11.9. Small companies about 16. Remember, we did that calculation. I said it was a geometric average, and we got about 12%. So that's the difference. These geometric averages are going to undervalue any given year. Long-term corporates, 6.3, government bonds, a little under 6, and treasuries, 3.4. Note also over here in this column, they're mentioning risk premiums. So here what I'm doing is I'm subtracting off something that I would consider riskless. So the typical security that we use as a risk-free proxy is the T-bill. Now, in today's world, and you'll find this to be a problem once we start getting into the security analysis and you start calculating risk-adjusted returns for a particular company, and you're using capital asset pricing model, using the Treasury bill as a proxy for the risk-free rate over a long period of time is not necessarily good in a period of time when the Treasury bill is close to zero. What we want to use is really an average over a long period of the Treasury. So there we're talking more about like something like this, 3.5%. So to get our risk premium, we take off the risk-free return, and that risk-free return is proxied by the Treasury bill. So basically this 11.9 minus 3.4% gives us our 8.5. And 16.2 minus 3.4 gives us our 12.8. So that's the extra bit that we get for taking a risk. The 8.5% is the risky part of that return. The 3.4% is what we would ordinarily get as a risk-free rate anyway. So when we want to talk about a risk premium or a market risk premium, we're talking about this column. Pretty obvious that there is some reward for taking on risk, and notice here that the riskiest of them, the small company stocks, have the highest reward. Next risky large company have the next higher, and so on down the line. So we rank order these, and it does look like as we take higher risk, we get higher return. That should be pretty obvious. The question of why does a risk premium still exist is actually a good question. It's a relevant question because we've looked over 100 plus years and sometimes even in 200 years, and we've seen huge returns on average. And so why would anybody pay us for taking something that over long periods of time seems to be a given, right? We're pretty assured of getting a good return. And the answer to that question is not very simple. In fact, economists and financial economists still argue about this. And why should there be a risk premium at all? And has that risk premium shifted over time? We're not going to have time to delve into the intricacies of that, but it's a question that you all should know is out there and that people are still debating this. There are a lot of financial economists that think that the market risk premium has actually dropped. Part of that is a function of our tolerance to take on risk. Maybe we're, as a group, not any individual, but as a group of individuals, maybe we're more willing to take on risk. And as a result, that means that we're willing to accept a lower return for any given level of risk. But don't take the fact that a risk premium is a given and that it's always going to be constant. That's the key takeaway for you at this point. So how do we measure this risk? And the best measure that we've come up with is a statistic called variance. And when we take the square root of variance, we end up with another statistic that's called standard deviation. And we use those statistics to measure risk. And we also make an assumption that we have a normal distribution. Sorry for the noise here. Let me turn off my phone. We assume that the returns that we're looking at follow a normal distribution. So we're talking the bell curve, right? You all should have seen that in statistics. Whether you remember it or not, it depends on how long ago that was, right? But here's a histogram that shows us on an annualized basis where the returns stack up. And if you squint your eyes and kind of hold this at a real distance, it might look sort of like a normal distribution. Not terribly so, but actually if we break the time frame down into a slightly smaller period, it looks a heck of a lot more normal. So the interesting thing about a normal distribution, and this may or may not be something that you learned about in your statistics or econometrics class, but you should know that as long as I know that something follows a normal distribution, and I can pretty well be assured that it does because of the, where did I put that? I don't have it in this deck. Well, the central limit theorem makes the argument that basically if we have random draws out of any distribution or out of any population, that those random draws will end up looking like a normal distribution. So as long as I can assume a normal distribution, I only need two parameters in order to estimate what that distribution actually looks like. I need its mean, which is the average return, and I need its variance, which is what we're about to look at right now. Why is that important? Any ideas? Maybe you did have some of this in statistics.
The
How about
mean
other
kind of, oh, sorry.
Oh, go ahead. No,
I was
please.
about to say the mean kind of just shows where the point of that bell curve would be. So how concentrated that is up until the middle or leading up into the middle. And then the variance shows like how far you deviate from that mean. So how consistent the data is or whatever we're measuring is.
Right, absolutely. You're right. The mean gives us the measure of centrality, kind of the middle of this thing. And the variance gives us how spread out it is. Is it really tightly packed around the mean, or is it spread out? But that's not necessarily what is as important about the fact that just those two things can define what this curve looks like. Mind you, here's the, let me jump over here. There's the curve. That's the theoretical normal distribution. What you may or may not know, again, about other distributions is that they require more parameters. So they require possibly knowing about skewness or kurtosis, which are the third and fourth moments of any distribution. Here, I don't need to know skewness or kurtosis because there is no skewness. This is a symmetrical distribution. And so basically just those first two moments, those first two parameters, and I can tell what this distribution looks like. Why is that really important? Because when I'm developing theory, the more parameters I have to estimate in my theory, the more difficult it becomes. So if I add a third parameter, it just doesn't become 50% more difficult, it becomes like 10 times more difficult. And so when we're talking about something like the capital asset pricing model, if I only have to estimate two parameters to get my solution, I've saved myself a lot of effort. So to the extent that returns generally follow a normal distribution, that saves the theoreticians a lot of work. And also gives our theory a little more credibility too, because we don't have to estimate those extra parameters. There is a fly in that ointment, though. There is a flaw in this, and we'll see this in just a minute. But first, let's go back to how do we calculate a variance? And I'm sure this should be a review for you all, but think about this formula right here. Again, we've got the sum. Darn it, I don't know what's going on with this. I need to get a new cable here, I think, for my display. That thing is really heating up, and maybe that's why I'm losing that connection. Let me know if I didn't notice that until just now. Let me know if the display goes away, please. So we've got a summation here from 1 to n, and what we're doing is we're taking the difference of the periodic return from the mean. This R bar is that mean, or the average return. And then we're squaring it. The reason we square it is to get rid of the negative sign. Because if we didn't square it, you know, the RI's on to the left of the mean and to the right of the mean would generally cancel it out, and we'd come up with 0. So that's not helpful, right? So we square it to give us something to work with. So the further away it is, the squared value of that is even much bigger. It takes all the negatives out. So the bigger this numerator, the more dispersion about the mean. And then, of course, we divide it by n. But in this case, we actually subtract 1 off of that n. I'm not going to go into the esoteric statistical reason for it, but think about it as that 1 represents the fact that I'm estimating an average. This is not a population average. This is a sample average. So it's an estimate. So I'm losing 1 degree of freedom. So that's why it's n minus 1, not just n. All right? So that's variance. The trouble with variance when it comes to something like returns is that I don't know what a squared return is. It has no definition in our world. Now, squared speed is acceleration, right? So if we're in physics, we can deal with something that's a variance. There is a definition for that. But in finance, there is no such thing as a squared return. So to really talk about it in any sort of practical terms, we want to take the square root of that variance, which is also got a name in statistics, and that's a standard deviation. So we take the square root of that. That gives us our measure of dispersion. How risky? If it's spread out a lot, it's more risky than if it's packed around the mean very closely. This is just a repetition, so I'm going to skip over this. Here's that theoretical or stylized normal distribution. Now here is the really interesting part about this. And again, this is hotly debated still to this day in the finance world. And that is that when we look at the return series in great detail, we find that it doesn't quite follow a normal distribution. Notice the normal distribution here is the bolded line. The other distribution is called a leptokurtic distribution. It's leptokurtic because it is peaked in the middle, and it has fatter tails out here on the extremities. And it's kind of, there's less probability in the middle, or either side of the middle, rather, I should say. Now, the probability still adds up to 1, but what we find, so this is important to us as students of investment, because in particular, over here on this left-hand side, the models that we're using, the CAPM in particular, and any other pricing model that uses the normal distribution as the representation of returns, doesn't fully capture what happens in the real world. What happens in the real world means that these big negative numbers are much more likely to occur than the theory suggests they occur. And these have been called black swans because black swans are rare, right? Most swans are white. Occasionally you run into a black swan. That's that really negative return, that financial crisis or great market crash of '29 type of return. It can happen to the market or it can happen to an individual security. But note that our models that assume a normal distribution don't capture that fully. So we are underweighting these really drastically bad outcomes. It's an important insight to have. Now, I should also say that that doesn't mean we should just throw the models away. The models are valuable to us because they're the best representation we can get. They're not first best, but they're at least second best, right? And since we can't get first best, we're willing to accept second best. Now, with computer technology where it is, doing some sort of numerical analysis might get us closer to first best. So most of these theories were developed in the days when computing power was difficult. And you know, when my mentor, not myself, I still had to learn how to invert matrices, but my mentor actually, in order to do his research, had to do it by hand. You know, he was inverting these huge matrices by hand. So computing power has grown dramatically, and now we can find a numerical solution that might be better than the theoretical models. And people are working on that as we speak. Good times, I'll leave that to you to look at, but you know, there have been some pretty dramatic positive returns in the marketplace, and there have been some pretty dramatic negative returns in the marketplace as a whole. Obviously, if we're looking at individual securities, we've seen them vary even further. Geometric versus average, in the interest of time, and that this is really in your reading too, I won't belabor it too much, but what you'll find is that geometric underestimates the return relative to arithmetic. You can see this most explicitly when we look at extremes. So let's say in year 1 we have a return of a positive 100%. In year 2 we have a return of negative 50%. If I do my arithmetic average, I have 1 minus 0.5 is equal to 0.5, and then I divide that by 2, and I get a arithmetic average return of 25%. All right. Now, if I'm doing that as a geometric return, what do I have? Well, I have 1 plus, let's see, how best to show you that. Let me start. Let me just show you from a dollar perspective. I'm starting with $1. At the end of year 1, I add another dollar to that. So at the end of year 1, I have $2. So that $2 goes down here to year 2, and I lose 50% of that. So I lose $1 out of that. So I end up with $1. So I began with $1, I ended with $1. The geometric return ends up being 0. All right? So the extremes sort of proves the point. Now, obviously, in the real world, the difference in returns is not that dramatic, and you'll find that here's the comparison, but you'll notice that this is lower than that. This is lower than that. So when do we use each? Well, if you're looking at trying to figure out what an average year is going to look like, you'll want to use the arithmetic. That's the best estimate. If you're looking at what's my return going to be over multiple years, 10, 15, 20 years, so longer term, you're going to want to use the geometric. All right?
Could you go back to the black screen just for like a quick second?
Sure.
All right, thank you.
I'm sorry, repeat your question, Brett?
Could you just go back to the black screen really quick?
Oh,
Unless
I
you
can't
cleared it.
because it clears it every
All
time
right,
I
no
go
worries.
back.
No worries. It's all good.
What was your question though? Do you remember the numbers? Or?
Just like the second half of the geometric mean one, like where we started with $2.
Oh, you start with $2 and you lose 50%.
Okay.
Right. So 50% of 2 is $1. So subtract off that $1, you're back to the original $1 that you started with at the beginning of year 1.
Got it.
All
Perfect.
right.
Sorry about that. Thank you.
Oh, no problems. I apologize. Unfortunately, that black screen clears every time I go back to the slide deck. You can pick it up too in the video. So one other thing before we close out chapter 1, and that is dollar-weighted returns are yet a different animal. So a dollar-weighted return takes account of when we put the money in. Now, if we just put one lump sum in at the beginning and we follow it to the end, then the dollar-weighted and the geometric are the same. But if we add money over a period of time, not unlike you might do with a IRA or some sort of investment plan where you start with 1,000, then you add 100 every month, or whatever your plan is, then the dollar-weighted returns become more important. The best way to calculate those is to use a spreadsheet. And there you can do it, or obviously your calculator can do this as well. The 10B2 or the BA2 Plus will do this as well, but uneven cash flows. So here we just put in our initial investment is 1,000, and we get a particular return that year, and then we put in another 4,000 at the end of that year and let it ride another year, and it also has a return, but we end up with only 48.45, and here are the here are the annual returns. There's 10% the first year and -5 the second year. So we end up actually with 48.45, which is less than we actually put in. So this dollar-weighted return is a more accurate measure, whereas if we just looked at the arithmetic or the geometric, it's actually going to show us positives. But because we put more money in at the beginning of the second year and that return was negative, then our dollar-weighted return actually is the more accurate measure for this. All right, I think that's pretty much it for that slide deck. Got about 20 minutes, so that gives us time to get a start into chapter 2. Come on. Oh. All right. Where did chapter 2 go? Tell you what, I'm going to go back to my files, and I think I can find it there more easily. There we go. This is not my right copy, unfortunately. I think we can still persevere here, though. All right. So chapter 2 starts off by talking about the investment process. That's something that, for the most part, unless you have questions, you can ask in the discussion, or we can, if you want to ask during class, we can talk about that in more detail. But it's just talking about the process that you would use to set up a investment plan, what they call the investment policy statement. The one thing I want to point out in particular to you is right here under strategies and policies, and the market timing piece of this and the security selection piece of it are things that I want to warn you about in many regards. Market timing is basically a fool's game. Essentially what market timing says is that I think I know better than the market when it's going to turn around. So I know when to put my money in when it's going up, and then I take my money out the moment it starts turning around and going down. And then when it's bottomed out, I put my money back in and let it ride up. So all I'm doing is catching the upswings. When I've got my money out, I'm just putting it into treasuries. So I'm still earning the risk-free rate on that. That strategy, it does not work. Might work for a while, but it doesn't work after a certain length of time. And you don't know when that period of time ends. So market timing is really not a good plan at all. Now, that's not to say that a lot of people don't claim they can do it. And yet they still can't really do it. The other thing to be wary of, and this is much less of a warning on security selection. Security selection is also potentially a cause for you to lose a lot of money. Now, we're going to be talking about security analysis, which really is the precursor to selecting a security that we might include in a portfolio. So I don't want to completely dissuade you from using security selection. That's a fairly tried and true method in the finance world. But you have to do it with care still. You still have to take a good bit of care, and we'll talk more about that when we get into talking about modern portfolio theory and how I might be able to mix the security selection with a broadly diversified market portfolio and capture the best of both worlds. So just a couple of warnings. The other thing is to note here is that most of the returns that we get are going to come out of our choices in terms of asset allocation. And when we're talking about asset allocation, we're talking about these big categories of securities. So we've got one group that we call equities or stocks. We've got another group that we call bonds. We've got another group that we call currencies. We've got another group that we call commodities, real estate. Those big categorizations of different types of securities are what we're talking about when we choose our asset allocation. So what we're choosing there is what percent of our money are we putting in stocks? What percent are we putting in bonds? What percent do we put in currencies, commodities, real estate? And then we could even throw in derivatives as kind of another general category. So asset allocation is what usually drives the vast majority of the returns that we get. It is not market timing, and it is not, curiously enough, security selection. And yeah, okay, so I just wanted to make sure I had the next slide I was hoping to have in here, because I think I opened the wrong slide deck. But in any case, notice here the research that's been done, and there's an extensive body of literature that shows this. 90% of your returns are due to asset allocation. That is, when you choose what percentage in stocks, bonds, real estate, commodity, currencies, derivatives. When you make those choices, you have determined 90% of your return. 10% is how you pick securities within each of those broad categories. And this paper really puts a fine point on it. This paper is by Hank Bessenbinder. He's a researcher that actually, when I was a doctoral student at U of A, he was a professor at ASU. He had gone away from ASU for a while. He's actually back at ASU now. Really quality researcher. He wrote a paper that's gotten an immense amount of attention. And basically what that paper says is that the vast majority of returns since 1926 have been generated by, this number, I should have put it in very large font, 4% of the stocks. In other words, the other 96% of the stocks didn't generate one bit of return for me. Remember back to that graph we were looking at? That $6,500-ish dollars, starting with $1.26, ending in 2018 with over $6,000. That $6,000 came from 4% of the stocks. An amazing figure. I've got links to the paper, and here are some links to articles that are both stating that, hey, this paper has made the case for security selection. And the other one actually is saying, oh, this paper has made the case not to do security selection. So the interesting thing about Hank's paper is that he has generated huge amounts of practitioner dialogue about his academic paper on both sides of the category. So the academics are more of the buy and hold the market portfolio, don't worry about security selection. The industry is much more of, wow, yeah, I can pick out those securities. So what the industry proponents are saying is that we know how to pick those 4% of the stocks, and we're going to allow you to generate a much bigger return than the market generates. And we know which 4% are going to do that. The other side of the argument says, oh, no, there's just no way you can tell which are the 4%. You can look back and you can tell which were the 4%, but you can't tell going forward which they are going to be. So it's an interesting debate. I encourage you to click on those links and kind of read through both sides of the arguments there. And again, all of this is simply opinion, right? Now, the research itself is well-founded fact. But the rest of the discussion is pretty much opinion. Choosing a broker and in advising, again, I'm not going to spend much time on this. I do want to point out to you, if you look at those Khan Academy videos, they're fairly short. If you're interested in figuring out the difference between a traditional IRA and a Roth IRA, and actually, you guys should be doing that or thinking about it when you get out of school immediately. Put your money to work now. Don't do what I did. I started off as a science major, remember? I wasn't making much money. I didn't have anything to put away. And now I'm trying to play catch up. You guys have not only the knowledge, but the time on your side. So make sure you start putting money into one of these things immediately. And as far as which one to put it into, this Brown, Cederberg, or Doherty paper actually argues and shows empirical results that argue that you should probably put half of your money into a traditional and the other half into a Roth. And I've got the paper link to that in the resources in the modules, and you can link to it right here too. But the short answer is do a 50-50 blend. I'm not going to go into any more detail. The Khan Academy stuff is pretty detailed and gives you a good overview. So let's see. SIPC, the only thing I want to say about that is the SIPC does not guarantee returns, right? So it's kind of the corollary as the FDIC is to the banking industry. It's the corollary to the brokerage industry. But what it does protect you from is if your broker goes bankrupt and your stocks were all in street name. In other words, they weren't directly in your name. And those go to pay off some of the creditors of the broker. This SIPC protects your money in that regard. And let's see. So next thing I really want to get started on here, we've still got about 8 minutes, is talking about margin accounts. So that's the part of this chapter that might be a bit confusing, in particular when we talk about short selling. So we may not get to the short selling today, but we'll definitely get to it on Tuesday. Pardon me. A cash account is just what it says. You put cash into the account, you use that cash to buy securities. In this case, we're going to talk about stocks. So you put in $50 and you can go out and buy one share of stock that has a value of $50. Margin accounts are something that you can't initially set up with your broker. Usually a broker requires that you've had a cash account for some period of time, have done a little bit of buying and selling in that account so that you're familiar with the vagaries of the marketplace. And then they'll allow you to start borrowing from the broker. And that's called a margin account. Now, a margin account does something that a cash account cannot do, and that is it allows you to short sell a security. So a short sale, in essence, is selling a stock that you don't have. Why would I want to do that? Well, the reason is that sometimes stocks go up, but sometimes stocks go down. So if I actually think that that particular stock is going to go down in value in the future, I don't want to buy it. How can I make money, though? If I can't buy it, I can short sell it, meaning that I sell it first, and then I buy it back after it's dropped in price. That's a short sale. Now, the basic essence, though, is that, whether it's a long or a short sell, I'm still buying low, selling high. So if you think about it, a long sale, I buy low, sell high in the future. A short sale, I've just reversed when I sell and when I buy. So I sell high today and I buy back in the future at a low price. It's still buy low, sell high. It's just I've switched the timing around. All right. So here, I'll just skip over the cash account. They give you a little bit of a T account here. We're going to be using these T accounts to simplify thinking about this. So asset on the left side, liabilities and equity on the right-hand side. This one should be pretty obvious. We use, oops, wait a minute. That one actually jumps into the margin. So here we've got a margined purchase of a long position in the stock. And so we're purchasing 100 shares of Walgreens Boots Alliance at $80 per share. And we have $5,000 of our own money that we're putting up to do this. And the rest of it, the $3,000 extra, we're borrowing. So this is in a very important formula here. The margin is basically the percent of the investment that is your equity. So essentially the formula for margin is your net worth or equity position divided by the value of the position in the security. So you have, when we open this up, you have $5,000 of your own money, and the value of the position is $8,000. So you actually have a 62.5% margin. 100% margin would be a cash account, right? Now, the least margin that you can open up a margin position with, and this has been the rule for a long time, is 50%. Back prior to the 29 crash, you were able to borrow up to as much as 90% of the value of a security. And most economists that have studied that period argue that that was a large extent the cause of the crash, is that so many people had such a small margin. So they'd have 10% margin in their positions. And that's what caused the market to drop so precipitously in 1929. Now, we can have that when we're talking about real estate, right? We might buy a $100,000 house, have $10,000 of our own, and borrow $90,000. Well, the housing market isn't as volatile, nor do we trade it as frequently as the stock market. So people are comfortable with that. You'll also notice, though, even in the housing market, the more down payment that you have, the lower the rate you pay on the loan. So that's representing the lower riskiness of that loan, right? Here, the federal government, I believe it's the Federal Reserve Bank, sets this rate, and they have set it at 50%, and it's been that way for decades. No less than that. So a purchase, we buy low today, and we sell high tomorrow. Now, some of the details of margin accounts and some of the terminology that's unique to them. And then I think we'll have to stop at that point, and we'll do the example on Tuesday and go on from there. But some of the terminology, we have an initial margin, and that is a minimum of 50%. You can have more, up to obviously 100%. But that's what you open the position with. Now, there's this other term called the maintenance margin. Now, the maintenance margin is always set below the initial margin. So once you've opened the position, let's say I bought a stock. Let's say I bought this stock right here, this one that we're looking at, and it was $8,000. But let's say that the price of that stock dropped. So all of a sudden my denominator gets smaller, but I still owe the $3,000. So my equity position gets smaller as well. And that's going to cause my margin to drop. Now it can drop down to, maybe it drops to 50%. If my maintenance margin let's say it's 40%. I'm still okay. If the price continues to move against me and it keeps going lower and lower and lower, and eventually my margin drops to 38%, as soon as it drops below 40, let's say it dropped to below 40 today, and at the close of market it was at 38. My broker is going to get on the phone with me and say, hey, this is a margin call. You need to deposit more money into your account or I'm going to close the account out. And so what I have to do is I have to deposit sufficient cash into the account to bring my margin back up to at least the initial margin. Let's say that in this case it was 50%, even though we put in more money. All we would have to do is bring it up to 50%. If we did that, the broker would say, okay, we're fine, we'll leave the account open. If the price continues to drop and I get another margin call, I would either have to put more money back into the account again, or they would close me out again. So that's the difference between those two terms. Initial margin is when I open the account. Maintenance margin is the bare minimum that has to be in the account at any given point in time. Elsewise, I will get a margin call. I think that's a good spot to stop. Any questions before we close up? No? Well, I will see you all then on Tuesday. Don't forget about the reading. Friday is chapters 1 and 2. Do the Smart Book 2.0, and then by Monday at midnight, have read chapter 3 as well and do the exercises in Smart Book 2.0 as well. Thank you. Have a good weekend. Bye-bye.
Thank you. Thank
Thank
you.
you.
Dr. Elliott.
Yes.
Hi.
Hang on a second. Let me pause or turn off the recording here.